In this video, I wanted to discuss how to properly backtest third-party EAs. This video is sponsored by Prosperity Algo and our free Golden Time Bomb Expert Advisor. Do you want to make 100+% annual returns through automating the London breakout and the opening range breakout? Then click the link in the description. So, here at Prosperity Algo, by now we have quite a few different people using our EAs, and quite often clients will test them, as they should, but they'll also try and change the parameters or come up with their own strategies, which is also fantastic, and I always encourage people to do that. But sometimes when people are modifying the bots, they do so in a way which might be not necessarily following all best practices. Therefore, I wanted to make this video mostly for our own clients, just to give some tips and tricks as to how you can change the strategy to your liking, but in a way which is robust and is less likely to overfit. So this video is really going to focus on how to backtest and run optimizations for third-party EAs. So we're not going to go super into detail about more advanced methods like Monte Carlo analyses and walk forward, and there's like a bunch of different types of out-of-sample testing, but I find it's a bit more challenging to do that with third-party EAs. You absolutely can, but really what most people will do, if they do it properly, is just a basic out-of-sample test where you can optimize or train on a small sample of data and then run on a significantly larger out-of-sample period to make sure that the parameters are robust and it works in different market regimes. So here's kind of a little diagram which would illustrate how this would work. You could either optimize on in-sample and then test on kind of forward data, or alternatively, sometimes you can even like test on or optimize on more recent data and see if those parameters work kind of going backwards on historical data. So lots of different ways of doing this, and I'm sure and I know there's many books written on this exact subject, so it can get quite complex. But really just to talk like high level about some best practices. Like, we have to start off with the concept of market regimes. So effectively, with any market, be it the gold market or futures or equities, there's different periods which are driven by fundamental events. So here we see a pretty good example of, like, I believe this is just an equity chart, maybe it's one of the large equity markets, but it shows that during different time periods, like the global financial crisis, the COVID crash, etc., price action behaved extremely differently. So let's say you were to take a strategy and you optimize purely on the COVID crash, that likely would not be the best parameters for the entire sample of data, right? Because the actual behavior of price during a period will be heavily influenced by the general market regime, so how market behavior is happening at that given time. So generally speaking, if you can have a strategy which works reasonably well over many different market regimes, that's usually pretty good. So the big kind of warning here is if you take the past few months of data and you run many optimizations over a very short time period, you have to factor that might not work super well going forward because it could be over-optimized on a very short period of data. And certain fundamental events could have been driving that. If we look, for instance, at the past few months, we're now in January of 2025, had you optimized the system on gold, which only went long the past year, you likely would have done fairly well, just because gold was in a very bullish phase. However, if gold were to go into a bearish phase in the next year, and you optimize purely on bullish data, it likely wouldn't be super robust going forward. So you always have to consider that and take that in mind. So don't over-optimize over an overly short period of time. Another big consideration here when running optimizations on third-party EAs is don't change the strategy if you don't mean to. And what I mean by this is most bots and most systems fall in certain camps. There's more scalping strategies, which tend to have very high win rates but low risk reward, or there's more like swing trading strategies and there's one-to-one risk reward bots. So if you start to take a bot which is designed as a scalping system, which many of our bots are, and you make the risk rewards completely different, you can very much change the underlying strategy. So it may be profitable, but you might also be invalidating the premise which the bot is built on. So in this, for the rest of the video, we're going to use our golden time bomb bot as an example. Time bomb is a scalper, and here you can see its risk reward settings with a relatively large stop loss to its take profit. And here, for instance, if you were to make it a 1-to-1, so you were to make the start trail, which is when the take profit trailing stop loss starts, equivalent to the stop loss, the equity curve would look completely different because you're all of a sudden essentially changing the reasoning behind the bot, because you're not trying to scalp quick impulses at the open. You're now trying to trade a continuation once a range is broken at the open. So if you fundamentally change the risk reward, you're changing the strategy. So you have to be really, really careful there, and don't do this just haphazardly. You really should understand what you're doing, because it can make a massive impact. In terms of optimization, there's a few kind of best practices which I would recommend. You typically want to optimize over large steps. So what that means is, let's say, going back to our stop loss here, you don't want to optimize with every 0.001 intervals. You want to perhaps say like, hey, we're going to optimize in 0.05 chunks here and go from 0.1 to 0.25. And then you just have a few different possibilities to test. It's a handful of different possibilities. And also, I'd be very hesitant to optimize too many parameters, because you just increase the risk of overfitting. So be very careful with that. Also here, I'd always recommend doing some sort of out-of-sample testing. Maybe you want to optimize the parameters on recent data on the past 6 months, but you should take those same parameters which you get optimized over the past 6 months and run a longer backtest. Usually I like to do 2022 and see how they performed in a few different regimes. If price went straight down until your optimization period, you likely over-optimized. So what I've seen a few times is guys will take the past 6 months, they'll run over-optimizations on that, and they'll find the best set of parameters which make it go straight up. But then if you take those same parameters and you just run a quick backtest from 2022 to today, it goes straight down for years before going up. So you have to be really careful there. So kind of concrete next steps, if you want to optimize in a short period and then just but see if it works on a broader period of data. Do so with big steps, so you're not using too many permutations, which increases your risk of overfitting. And always be mindful to not massively change the strategy. And let me pull up MT5 here with our time bomb system. Here you can see our time bomb system. It's a 1-year backtest, and it's making a bit over 100% annual returns. And what's pretty cool is you can also check out our live signal, and the live signal matches the backtest almost perfectly. I think we have around 90% performance, which is pretty cool. And here we can see, if you go into the backtest tab or the inputs tab, you can optimize it for your own liking. So here, for instance, we're using our classic scalping risk-reward ratio, but you'd be able to increase this. So let's say instead of doing a 4-to-1 or a 3-point-something to 1 risk-reward because of the trailing stop loss, you wanted to make the risk-reward less inverted. So you could switch it to 0.1, 0.1, and then run a quick back test here on 2024. And here we see it's looking really good too. But now what I'd also encourage you to do here is like, okay, this worked well in 2024, but how does this look since 2022? And then you go and run another back test here. And I would even encourage you guys here, if you're running any sort of optimization on third-party EAs, if you're able to not use the built-in optimization functions in MetaTrader, that's probably even better, right? Okay, here we're seeing the returns were even better. So 13% drawdowns, and yeah, 10 grand to 45 grand. Okay, that's pretty good. So here, this seems pretty robust to me. But essentially, to explain my reasoning here, I don't want to run a cajillion different permutations. So I could have run, using the optimization functions, a bunch of different steps, and that significantly increases the risk of overfitting. Versus here, my logic was just like, okay, this is still a scalping system, so if I make the start trail just a little bit bigger, so we slightly decrease the risk reward, does that fundamentally change the strategy? I'm like, not really. It's still ultimately the same strategy. And let me just quickly now test it over a relatively short period of data, which was 2024. cool, that looks pretty good. Now let's just run it over a larger period to see how that works. So I did that with 2022 and it still looks good. So that was kind of my reasoning here. And that's essentially the type of reasoning that you should also have. You shouldn't say, okay, let me take the last 6 months here, 2024, 07, and then I say, okay, I'm gonna run a slow complete, balance max, and I'm just gonna optimize the crap out of all of these parameters and run a bunch of different steps and have, what is that, 68 million different combinations. Don't do that. You will get something which is heavily, heavily overfit. And then people always pick the best one, which is a terrible idea. Do not do that. That's essentially what I'm trying to get at, is that the big point of this video is if you optimize, be very careful. A few other points here is if you are running any sort of optimization, please, or any sort of backtest, please use every tick based on real ticks, because unfortunately if you use every tick, it does not take into account spreads that well, and for these types of scalping systems, it will make your backtest look like absolutely astronomical. So here we're turning 10 grand into $75,000. I wish that was the case. We'd all have a fleet of Lamborghinis, but unfortunately that's not the case. So the final takeaway here would please use every tick based on real ticks, as it gives you a much more realistic and live signal matching type of performance. So guys, please let me know if you have any questions. Hope this video was useful, and have yourselves a great day.